Hello, welcome to Navigating Estate Planning with Caress Law. I'm your host today, Tammi Caress, and I bring you some exciting news, a new development in Washington State related to taxes. When I said exciting, I was being facetious. And now it's time for the disclaimer. The information contained in this podcast and associated material is intended to furnish listeners and users with general information on matters that they may find to be of interest. The information in this podcast provided by Caress Law and its agents are for general guidance and is not intended to replace or serve as a substitute for any advisory, tax, estate planning, or other professional or legal advice, consultation, or service. Sometimes we may reference third-party materials or websites. Such links or references are only for the convenience of the listener, user, or browser. Caress Law and its agents do not recommend or endorse the content of third-party information or sites. You should consult with appropriate Caress Law professionals or other professional advisors for advice concerning specific tax, estate planning, or other matters before making any decision. In summary, this podcast is not legal advice. If you need legal advice or before acting or making any decision with anything talked about in the podcast, seek the counsel of an attorney. Thanks so much. Today, we are talking about taxes, and in particular, taxes in Washington State. New law was just passed that affects the estate taxes as well as the long-term or state-level capital gains tax. And I thought it would be good and important to share with all of you what those changes are. Some changes are good, but of course, other changes related to some of those changes will have a greater financial impact on many individuals. I am your host, Tammi Caress, founder of Caress Law, and we serve clients in both Oregon and Washington State. And I bring you this podcast in hopes that it will help you gain some understanding of how to protect yourself and your loved ones. All right, we're going to talk about the estate tax. First, what is the estate tax? It's a tax assessed at death for decedents who pass away and are residents of the state of Washington, or they own real property or tangible personal property. Real property is a house or land. Tangible personal property can be a vehicle, a camper, trailer, a boat, or just the items inside your home. This estate tax under current law is, or I should say former law, but the current law hasn't gone into effect just yet. But under former law, the estate tax was only applied to those who have an estate value of over $2.193 million. So essentially what happens is when a person dies, we have to value all of their assets. And I have many podcasts and webinars and things like that that talk about what the assets are of an estate when a person dies. But we value all of those assets, and if the total value is over $2.193 million, then an estate tax is assessed. And that $2.193 million is called the exclusion amount. It's the amount that's excluded from estate taxation. So if you meet that threshold, the tax is assessed on the value above that threshold. This threshold is changing, which is actually good news. The threshold for decedents who die after July 1st, 2025, the threshold or the exclusion amount will be $3 million. So we're essentially increasing the amount that would require a person to file the Washington State estate tax return by about $800,000. So 2.2 million up to 3 million now. So that's the good news. I know many of you who live in Washington, the housing prices have gone up, especially if you're living in metropolitan areas, and owning a house and retirement, accumulating that retirement account and so forth can get you into that 2.2 million threshold fairly quickly. And especially if you have two working spouses who are contributing to that pot, if you will. Just for clarity, that threshold, that $3 million that we're moving up to for Washington, that is per person. It's not per family. So if spouses are married, obviously, and if one spouse dies, that's a $3 million exclusion amount for that spouse. And then the surviving spouse has their own. And if any of you have worked with me in the past, there are ways we can minimize the overall tax burden for the family by utilizing those exclusion amounts in their estate plan. In any event, so that's the good news. The estate tax threshold to be susceptible to that estate tax is $3 million per person. However, the bad news with this is, I guess it depends on how you look at it, good or bad, but the tax rate is increasing. So under existing law, before this new law goes into effect, the tax rate starts at 10% and it goes on up to 20%. Starting July 1st, 2025, the tax rate will still start at 10%, but it will go up to 35%. And it's a graduated scale. So essentially, it moves up for every $1 million that the deceased person has in their estate. So it goes from 10% to 15, 17, 19, 23, 26, 30, and then ultimately at 35% for estates that are $9 million and up. So that is quite a significant tax jump. And I will, it's good to be knowledgeable of this. There's many folks who will not be susceptible or will not have to worry about this tax, but those who do, you need to pay attention. There is a federal estate tax as well, but that threshold is quite high. However, when the federal estate tax exclusion amount was much lower, we used to do some pretty significant advanced planning because the tax rate on the federal level is 40%. Here in Washington, it's now 35%. So I foresee a lot more advanced tax planning strategies that will be needed in clients' estate plans to try to minimize this overall tax. A few things to note about this tax. There are deductions for family qualified businesses and farm deductions. There are requirements that need to be met. So if you have a family business or if you are a farmer essentially, and that business or farm production is being passed on to a qualified party, then there is a tax deduction that is $2.5 million that can be taken on the estate tax return. It is going up to $3 million as well as of July 1st, 2025. There are requirements to see if the estate is qualified to take that deduction, but it is important to know about. I know a lot of family businesses and family farms who, in order to pay an estate tax, would have to essentially sell the business. And that deduction is available to prevent businesses from going out of business and to allow families who most of their wealth is in that actual land itself. It will allow them to continue passing the farmland on as long as it's being used for farm purposes. I'm not speaking super eloquently about farm purposes and so forth, but it's just important to know if you have your own business and you have family members that it might be passed on to, same thing with the farm, then there are deductions available on the Washington estate tax return. Okay, so when it comes to estate taxes, if you are married, there is a very common strategy in your estate plan that can be done to minimize the overall tax burden. So it's important that if you are subject to this tax, that you have your estate reviewed, and or at least if you don't have one, putting one in place, because there are strategies you can implement to minimize the taxes. And then, like I said before, I think with this 35% rate, we will probably, I suspect, be doing more advanced tax planning strategies. A few other taxes to note. One is the long-term capital gains tax. I know this was kind of a controversial tax in Washington. Essentially 7%. It's a 7% tax on gains of $1 million or less. What's a capital gains tax? Essentially, if you own an asset for a year or longer, I'm talking about long-term capital gains. If you own an asset for a year or longer and you turn around and sell it, you're taxed on the appreciation. So an example is that we purchase Microsoft stock at $100 a share, and then we hold it for 2 years, and now that stock is worth $200 a share. We are taxed on the difference between the purchase price of $100 a share and the sales price at $200 a share. So effectively, Washington will take 7% of that $100 of appreciation. Under the new law, which actually is effective for this tax for 2025, so starting this tax year, that 7% remains. However, if the capital gains is in excess of $1 million, then it is 9.9%. So that tax is going up. I believe it is 7% on the first 1 million or less, and then it's 9.9% on anything above that. This bill was just signed by the governor, so I have a few tidbits of information, and I think we'll get more clarity as time moves on. But for now, those are important considerations and things to look at. All right. Well, I'll be talking about this a lot, I'm sure, in my coming webinars and some live presentations that I'm doing. I'm doing some in-person presentations coming up. So stay tuned for more information. But if you want to learn more about estate planning, or even the taxes, or how estates actually pass when a person dies, then please visit my website. I have so many resources on there that I think are really helpful. That's it for today. Thank you so much for tuning in. I appreciate all of you. Until next time. If you're enjoying the podcast and finding value in the content we're providing, we would greatly appreciate it if you could take a moment and support us by leaving a 5-star review on Google. This review helps us reach more people who might benefit from the information and insights we share here on the show. Plus, it lets us know what you like and how we can continue to improve. So if you're finding our podcast helpful and informative, please take a moment to give a 5-star review on Google. It only takes a minute, but it makes a huge difference for us. And also, don't forget to leave a comment too. We love hearing from our listeners, and your feedback helps us shape future episodes. So please help us spread the word and get the conversation going. Thank you so much for your support.